Have you ever considered the potential bankruptcy of banks? While it may not be an immediate concern, numerous banks are facing a decline as a result of substantial outflows and significant losses. The smaller regional banks are particularly feeling the impact of this crisis, and they may not be adequately prepared for it. Welcome to Nova Society, your one-stop shop for financial wisdom. Take the plunge and join our community for a brighter financial future. U.S. banks have witnessed an unprecedented outflow of funds, with a staggering $870 billion leaving since the Federal Reserve started raising interest rates. To put it in perspective, the initial rate hike occurred in March 2022. In just 18 months, American banks have experienced losses in the billions, with an average monthly deposit decline of around $73 billion. This is an unparalleled occurrence in the history of the United States, so much so that even the FDIC, Federal Deposit Insurance Corporation, has acknowledged the decline in bank deposits during the second quarter. It's essential to bear in mind that this information is the latest official data released, and it marks the fifth consecutive quarter of deposit reduction. Consumer trust in the traditional banking system is decreasing. The substantial and truly remarkable withdrawal of deposits serves as a striking alarm bell, prompting concerns about the conventional structure of banking and the potential for a banking crisis. The driving force behind this phenomenon raises questions. Is it a deliberate act, or can it be attributed to incompetence among those making decisions? Unfortunately, there's no definitive answer to these questions, and the truth might be a combination of both factors. Regardless, if you believe that the banking crisis had subsided, regrettably, there is no evidence to support such an optimistic outlook. The upcoming year is expected to witness a deterioration in the banking crisis, mainly due to the extensive exposure of most regional banks to commercial real estate loans. This is why medium-sized U.S. banks are maintaining significant cash reserves. According to a report from Reuters, U.S. lenders are holding onto large piles of cash as insurance against a slowing economy, continuing deposit outflows, and looming tougher liquidity rules that could particularly impact mid-sized banks. The significant rise in the cash reserves held by U.S. banks is a clear indicator that they are not anticipating positive developments shortly. Rather, they are making preparations for the worst-case scenario. In simpler terms, medium-sized banks are deeply concerned about the possibility of a situation where many people might simultaneously demand cash withdrawals. Therefore, they need to build up their cash reserves to meet these withdrawal requests, or else they could face the risk of potential insolvency. The second factor contributing to higher cash reserves in banks is the increase in consumer delinquencies. When consumers fall behind on their payments, it results in banks having to write off bad loans. If we examine consumer delinquencies up to this point, there is a noticeable uptick. In particular, auto loans and credit cards are leading the way, with monthly credit card delinquencies reaching 8% by the end of the second quarter, according to official data. Auto loan delinquencies are at 3.8%. With the resumption of student loan payments in October, unfortunately, delinquencies are continuing to climb. We've discussed two primary challenges that regional banks are grappling with: deposit outflows and the mounting issue of rising delinquencies, which translate into losses for the lenders. The third risk factor, which seems to be overlooked in discussions, is purely political. This factor may be part of a larger initiative aimed at reducing the number of banks and promoting more consolidation. The motivation behind this is likely aligned with the agenda of organizations like the World Economic Forum. So, the third risk factor that is putting pressure on small to mid-sized banks is government regulation. With a backdrop of significant economic and geopolitical uncertainties, especially considering the escalating situation in Ukraine where the prospects of peace are scarcely mentioned, and with uncontrolled immigration affecting societies, banks are anticipating increased regulatory interventions as a response to extreme economic stress and associated risks. The FDIC and other U.S. regulatory bodies have publicly announced their commitment to enforcing stricter liquidity and capital requirements. Liquidity, in this context, refers to the liquid assets, particularly the cash reserves maintained by banks. Capital predominantly encompasses a bank's assets, specifically the loans that are recorded on their books. An area of considerable concern emerges from the substantial quantity of unrealized losses that currently exist on the balance sheets of these banks. To elaborate on the distinction between an unrealized loss and a realized loss, an unrealized loss relates to a financial security whose value has diminished but has not been divested as of yet. The loss remains unrealized until the security is sold, at which point it transforms into a realized loss. The FDIC is reporting an increase in these losses as a response to rising interest rates, following a decrease in the previous 2 quarters. Unrealized losses on available-for-sale and held-to-maturity securities have risen to a substantial $558.5 billion, reflecting the amount of unrealized losses currently recorded on the books of U.S. financial institutions. This upswing in unrealized losses is primarily attributed to higher market interest rates and increased mortgage rates, which have led to a general decline in market values for debt throughout the second quarter. This trend is expected to persist as we await the official data for the third quarter. In response to these developments, many banks have begun selling a portion of these securities at a loss and directing the proceeds from these sales into their available cash reserves. This could potentially be seen as a sign of desperation in the banking sector. Here's an example. Bank of America, one of the leading financial institutions, recently made a revelation. They indicated that, during the initial 2 quarters, they executed asset sales amounting to an impressive $93 billion from the available-for-sale segment of their balance sheet. This sum derived from these asset sales was integrated into their cash reserves. The bank's objective is to actively mitigate its risk exposure. In an environment characterized by fluctuating market conditions and increased economic uncertainties, minimizing risk becomes the top concern. By divesting a substantial portion of assets, the bank can strategically reallocate its resources, thereby bolstering its risk management practices. This proactive risk mitigation strategy aligns with the bank's broader aim to fortify its financial stability in the face of ongoing financial challenges. Bank of America's decision to bolster its cash reserves by allocating the proceeds from these asset sales serves as a means to harness future financial opportunities more effectively. The bank recognizes the value of maintaining ample liquidity, especially in an ever-evolving economic landscape. The ability to swiftly respond to emerging investment prospects, financial ventures, or market developments becomes an invaluable asset. Furthermore, the increased cash reserves allow the bank to be well prepared for unforeseen contingencies, further enhancing its financial resilience. Their strategic maneuver is a multifaceted approach, designed to optimize its risk management, enhance financial flexibility, and capitalize on prospective opportunities. By prudently navigating the complex financial landscape, the bank aims to secure its competitive edge and uphold its commitment to financial prudence. This strategic decision highlights the adaptive and forward-thinking nature of financial institutions in a dynamic economic environment. The withdrawals from both regional and smaller banks may persist indefinitely, and even larger banks could encounter more significant outflows than anticipated in the upcoming months. While the larger banks may not be substantially affected by this turmoil, the situation is quite challenging for smaller banks. Their struggle is ongoing, and it will persist if the outflows continue to rise. If you want to learn more about personal finance and generational wealth building strategies, visit our channel and subscribe for more enlightening videos to increase your wealth.